Hello everyone, I am Atika and I'm going to talk to you about course MB2203 Financial Management. Continuing to our last session in financial planning, now we begin to talk about cash budget. So what is cash budget? Cash budget or cash projections are cash receipt and disbursement plans that are used to estimate the short-term cash needs. So usually it is done in 1 year period or shortened depend on your company preference. So the higher the season factor or the higher the uncertainty, the shorter the cash budget periods you must make. So we begin with preparing cash budgeting. So as I mentioned in previous session, it starts with sales forecast, which is the prediction of sales activity in certain period. It used as a basic for making monthly cash flow projections resulting from cash projections and also projected expenses. You can make the sales projection based on external projection, looking for the relationship between yourself and external economic conditions, such as you have the holiday season, whether it is related to your business or not. Or you can use the internal projection. Internal projection such as you can use the previous year sales as the projection, which is the sales forecast that based on the historical sales of your company itself. Or you can make the combination of both internal and external projections. So this is the example of cash budgets. Here we begin with the cash receipt minus the cash expenditure, then we get net cash flow. We have to add the cash at the beginning from previous month, and then we get the cash at the end. Each month you can make the minimum cash balance defined by your company's preference. And then at the end you can see whether you need financing or you have an excess in cash. Here we have the example from January until December. For example, here, remember we need to add the cash at the end on January to be cash at the beginning on the February, and so on and so forth until December or until the end of the period of your cash budgets. Let's see how to prepare the cash receipt. So we begin, as we mentioned before, we begin with the sales projection. We have the sales projection from January until December. And then you can make a budget, or you can project whether you receive all cash or not from your sales. For example, here you have received only 20% of your sales cash at the same month. So here from the sales of 100 in January, you only receive 20. As you have here, you only receive 20% in cash in the same year, in the same month, sorry. So here we put 20. And we still have the payment on the next month, or we have 1 month left for 50% of it. So 50% from 100. We put here 50 in February. We will receive 50 in February. And the rest of it, which is the 30%, we will receive in March. Okay, we can make here in March. And so on until December. If you have project whether you will receive another cash other than from sales, you can put it as well. Here, for example, we made 30 on December. So we sum all of it. In total, we have cash receipt for each month. What about the cash expenditure? We made the same thing as we did in cash received. So we begin from the assumption of the COGS based on the sales from January until December. We made the assumption based on sales, okay? If your payment is not happen in 1 month or in the same month, you still have to make the scheduling like we did in our cash receipt. Let's say here from your 70 COGS, you only have to pay 10% of it in the same month. So here we put 7. And the rest of it, we have 70% of our COGS, 70% of it in February. Here we have 49 in February. And the rest of it, the last 20% of it, we have in March, which is in around 14, right? Okay. And what about the other expenses? We must meet the budgeting as well. You have to know when you will pay the rent or how much payroll you have to put as expenses for each month, which month you have to pay your tax, or you are planning to buying fixed asset, which month you have to pay the fixed asset, and so on, and all the other expenses you have to pay. You put it here, and then at the end you have total cash expenditures for each month from January until December. After that, you put it again here. We already made the cash received, we already made the cash expenditure. Now cash received minus cash expenditure, we have the net cash flow. So we add the cash at the beginning for each month. So if we are calculating for the February, we have to add cash at the end from January. So we get the cash at the end for February. Remember, you can add a cash minimum for each month. It depends on your company whether you want to make it in the same amount for each month or you have a difference or special occasion for certain month. It depends on your company. So we can at the end have whether your company need more financing or you have excess cash. That's all from this session. I hope you learn a lot and find something useful for you from this course. I will see you soon for the next part. Bye!